Good afternoon, everybody. My name is Béat Koszinowski. I'm with Buckner, and along with me is Missy McGlone. We are both certified insurance counselors and also community insurance risk management specialists. Our specialty is real estate and construction insurance, and we handle the daybreak community insurance programs for a lot of the master association and anybody that lives in a townhome or a condominium. And we were asked to come out and talk about some fun stuff in regards to insurance. When it comes to insurance, most people think it's a very boring subject. I beg to differ, but most insurance never really matters to people until you have a claim, and then we start looking at the process, and it can be confusing, frustrating, and you feel like you've been treated wrongly. And a lot of things can be prevented that happen in the aftermath of a claim is by just doing some research, educate yourself. Earthquake has been a late hot topic. I kind of equate it to the elephant in the room that's always been in Utah ever since we can remember statistically. And I also said last year, the elephant in the room passed some gas, and everybody started to notice that there was an elephant in the room. And this presentation today is not really to fearmonger or inflict fear or get people worried. It's just something that we found a lot of people of late have realized that we have an elephant in the room, and it's causing some issues. People want to know more about it. One of the things in recent history that we've had, the Bluffdale quake, really didn't do any damage, but it created some additional unwanted attention from insurance underwriters, which in turn has increased our insurance rates. And so even though you were ignoring the fact that we had some more seismic activity and some other international events that affected earthquake pricing, most people really didn't care or know about earthquake insurance until, if they had earthquake insurance, they saw their renewal bill on the insurance policy. And what I was just going to talk about here is in the United States, earthquake seismic zones. Unfortunately, I like living in the West, Midwest, but when it comes to earthquake risk, statistically, anything in the red, orange, and yellow is much higher at risk for seismic activity than anything that you would see in the blue zone, which is the lowest, virtually no risk of earthquake, to green, very moderate earthquake risks. Now, to kind of give you some peace of mind, though, the Midwest in particular, but also Texas and the southern states along the coastal areas, even though those folks don't have to deal with earthquake, and you say, well, geez, I wish I could have it like these people. They actually, when it comes to insurance, have a lot more difficult time to get reasonable and affordable insurance than we in Utah, because they're much more prone to convective storms. And what that means is all the hurricane, tornadoes, and hail events that are causing a lot of claims, and more importantly, insurance rates, like in our Denver office or Denver HOAs, they pay 3 times as much in insurance on just the property insurance, with a high deductible for wind and hail, because statistically they just have a lot more frequent claims when it comes to wind and hail damages. So when we look at our pricing here for insurance for HOAs in general, Utah is actually an island in comparison to the West Coast, California, and even as close or far away as Denver, Colorado. Pricing in Utah is still very, very competitive. Do you want to go to the next slide? So we have the Wasatch Fault, the elephant in the room. That's actually 5 segments that are not just one line. I wouldn't lose too much sleep about like exactly where it's at. And especially when you live here, it's actually a very good area if you were living along the Wasatch Fault line, and I'll talk about that. But Brigham City has a fault line, Weaver has a fault line, Salt Lake has a segment, and so does Provo and Nephi. About 80% of the population in Utah live along the Wasatch Fault line. The state of Utah, actually, and I'm not going to talk too much about earthquake preparedness, but on the second booklet that I've kind of summarized everything and typed it up, there's 2 links that I've listed from the state of Utah and the University of Utah that have some very good information about like checklists on earthquake preparedness, what to do, how to prepare for it, how to deal with your family, loved ones, what to do and not to do. I'm not going to talk about earthquake preparedness today. This is kind of the map. Thanks, Missy. This is kind of the map here. This is the map in Utah that we show the fault line, and the red ones would be the fault lines that are more critical than the lighter colored ones. But as you can see, it runs all the way here on the east benches, and some of it going through Salt Lake actually. And where we're here at, there's not really anything to a fault line. So what if we're near earthquake zone, or we're living in an earthquake zone? There's a couple of other factors that are making a big difference between where I live. I actually live right next door on top of the Wasatch Fault. It's where we live, in Salt Lake. So it's a house from the 60s, and it was built to 60 standards right there next to the fault line. But we are also on solid ground, and where you located and how your home was built factors in greatly into how your house or your neighborhood is going to react to an earthquake. In Utah, we have an issue with liquefaction, and that means is if your home or your building is situated on a saturated soil, a sandy soil, it tends to act like almost like a sponge, and when the earth starts to move, you amplify the problem of what happens with the structure. And liquefaction is an issue here in Utah in some areas. You want to go to the next area. And so, again, if that's the Salt Lake, and here's Salt Lake City, our neighborhood is right here. Anything that where the Great Salt Lake was, and obviously the river is, along the river, it is a lot more prone to the movement of the soil liquefaction that's causing a ripple effect, in essence, to damage structures a lot more severely than if you're built in solid granite. So here in Salt Lake, in our area, you can see west and northern area of Salt Lake are a lot more prone, and then moderate here in the river area, to low on the east bench on granite, and over here on the Ochre Mountains, again, is less prone. That factors in. And what happens with liquefaction, even if you have a strong building, the soil will just give, and it'll cause the structure to collapse unless you really go down to bedrock and account for that. These are buildings from several years ago. Go to the next slide. I want to talk about just policy features and go a little bit into some details. And people get sideways when it comes to earthquake insurance, what it really means. And so most earthquake policies are only responding to something that is deemed an earthquake, but you could have earth movement, say that's also considered an earthquake, and I want to talk about that. But seismic activity or volcanic activity, we have the Yellowstone volcano, which could trigger, or in Hawaii, it could trigger an earthquake. So it could be because of seismic activities or a volcano, and then the subsequent damages that would contribute to the damage because of subsidence or landslide, rock slide, mud flow, or earth rising or sinking, shifting or settling on, or the eruption explosion of a volcano. That would be the definition of an earthquake. Sometimes we have people ask me, well, we live in Sandy, and what if we have the hill saturated with water and it starts to slide? That's an earth movement type of claim, and that would be handled under a flood insurance policy, or you'd have to get your policy to include earth movement, but that would not be an item that they would address. So earth movement, so if your soil just starts to settle because of water saturation, pore compaction, or environmental factors that are not considered an earthquake, typically that's not an item that a policy would cover. Most earthquake policies in Utah are written on an earthquake form. I always say all insurance is the same until you have a claim. So words and details do make a big difference. So when you purchase or look at an earthquake policy, you have to make sure you tell the agent or underwriter the items you want to cover, because if somebody shows you a $10 million limit, well, what does that all include? You kind of have to tell them line item by line item, just like when you order a sandwich, you kind of build your sandwich. You can't just say sandwich because they don't know what to put in there. So more primarily you would have real and personal property. If it's a real property, would be the structure, or if you live in a townhome or condominium, you would insure the structure and everything that's permanently attached. And then personal property obviously would be your personal belongings. And for an HO, it would be business income, or for an individual homeowner, and living expenses if you have to move out until your place is built back up. As an association, we will include association fees, and on the master policy that where Daybreak has insurance on your condominium or townhome unit, the association does not insure your personal contents or the loss of use. So they might replace it, subject to deductible, but your personal belongings and you having to live in a hotel or in a rental place until your home is put back together, that would not be the HOA master policy that would address that. That's your personal insurance. Building ordinance, because everything is so brand new, I'm not going to devote a lot of attention to it, but buildings as they age, just like my property in Salt Lake, they're outdated. They're no longer up to code. And as a property gets older and older, you could face additional expenses to bring your building back to code, and that is a factor to consider. But since everything is so very new here in Daybreak and built to a code after 2005, which is a very, very solid building code, and where you're located at, or risk for having a building ordinance claim is very little. Earthquake policies should cover replacement costs and not factor in any depreciation. Meaning if we have a home that was lost or a community, we need to make sure we get it replaced but not any depreciation. And most claims actually that you will have in an earthquake scenario with a building that has a fire suppression system is actually earthquake sprinkler leakage. That the building will stand, there's not really any major damages, but the sprinkler system will be torn apart and flood your structure, and that's one of those items that you need to check on your list. Obviously when we do business for our clients, when we find out that they have a sprinkler system, it's an automatic item to add on there, but that's a cost to the insurance. I didn't want to talk about deductibles, but we'll do that because a deductible is obviously a way for an insurance company to transfer some burden back to the homeowner or the owner that has some property you want to insure. As an example, you have car insurance and you nick your rear fender, you have a collision deductible at $1,000 and the damage is $250. You have a claim, but it doesn't meet the deductible. So how does that factor in with earthquake insurance? It's a little different. And there's two reasons why. One is the deductibles are typically much higher with earthquake insurance. Always so much higher. They used to be 5% along the Wasatch Front until about 7-8 years ago, where they redrew the seismic map and established that the elephant in the room, I keep talking about, was actually a bigger potential danger than what they assumed because of seismic activities and also research. And so what that did is a lot of insurance underwriters, in order for them to afford affordable premiums, we went from a 5% deductible to 10% deductible. And what does that really mean, right? What does that mean to you? What does that mean to me as a homeowner with earthquake insurance? Usually, like the example I just gave you, would be a deductible of $500 or $1,000 on your car. Once you meet that requirement, you're like, good, I have a claim, let's file it, let's move on. With earthquake insurance, we typically see that the deductibles are per unit. And what that means is we factor in the value of the building, which if you live in a townhome community, you'd have 15, 20 buildings, and I'll give you a simple example. And the average building is $1 million, and there's 4 units in it, or 3 units. So the per unit deductible of 10% does not mean it's 10% of the $1 million claim, but it's 10% of the actual structure that we insure. So if a structure is $1 million, it would be 10% of that structure, or $100,000. If your structure is worth $20 million, which we don't have any structures here, your deductible would be 10% or $2 million of that. That's a different animal, but I just give you that as a visual, and you say, boy, that's a big expense out of pocket. And people really get hung up on that. I did too when I looked at earthquake insurance, because you said, well, I have a 4-plex, 4 homeowners, and each we now have to face a potential shortfall of $25,000 or 10% to rebuild the structure. And people get very hung up on the fact that they want 100% insurance. A couple of things. One is it's extremely expensive to get a policy in Utah with a 2% deductible that does not otherwise have a lot of exclusions in the back end. So just with a lower deductible doesn't necessarily mean you're going to buy yourself a better policy, because as I mentioned earlier, all insurance is the same until you have a claim, so you really need to make sure you have a solid plan. And so it's better to have a really solid policy with a solid insurance company that's not going to be insolvent to pay the claim with the limits and a replacement cost form, and deal with a 10% deductible, because that's the devil that you know, rather than finding out you have all these mumbo and jumbo exclusions and limitations in your policy. So how do you deal with, let's say, as an example, if your community has $1 million structure and you live in a townhome unit that's $250,000. I just like to use that as an example. Most homes are more expensive, they're more valued more. Let's just easy numbers. So let's say I'm a homeowner living in a 4-plex, and they have earthquake insurance, but there's going to be $25,000 shortfall on each unit. I tell people, if you have, like in the community, is $20 million to build. Yeah, so in essence, you could have a $2 million shortfall as a community, right? If you add it all up, it's a tremendous amount of money. I tell my clients and myself too, you're going to be looking at rebuilding this, and you're going to be a very attractive customer to any contractor because they know you have an $18 million checkbook to rebuild your community. And it's really difficult to forecast what the construction pricing will be or materials and labor going to be. Everything is being going up. And typically when you have a catastrophic event, pricing will go up. But I can tell you, I deal with a lot of contractors, pricing is also driven by, if you buy in bulk, you get a much better price than buying an individual home. So if you're an average sized community in Utah of $20 million and you have an insurance checkbook now of $18 million, I would not really lose my focus on the $25,000 deductible, which is a lot of money for an individual person. But as a conglomerate, as a whole, you're going to be able to negotiate some good construction pricing that may not even factor into your deductible as much. Number one. Number two is you could give or take rebuild within 90% of value and not really be out a lot of money. And number three, if you do worry about your personal assets and belongings, you just don't want to deal with it, your individual unit owner or HO6 policy that is recommended that you get, you can add what is called an earthquake rider. There's different companies, different agents have different options, but it's typically very inexpensive to add an earthquake rider to your individual homeowner unit owner policy that then pays for your personal belongings. So if you lose your personal belongings in an earthquake event, they'll replace those. If you have to live in a temporary housing facility or somewhere where there wasn't any earthquake damage until your place is rebuilt, your unit owner individual policy will pay for that. You can add it. Yes, sir?
What if, let's say in your example, her structure was $250K. She chooses to move somewhere else. Can she take that bill and place somewhere else?
That's a great question, and if anybody asks me a good question, because I'm gonna give you some Swiss chocolate.
I'll think of some more.
Yeah, there's more right here. So that's a great question actually, and I don't want to go anywhere, so it really isn't applicable to me. But a lot of people ask me that question, and the question was, so everybody hears it in the room. I live in a townhouse, and it's now flattened, and I don't want to deal with Salt Lake anymore anyways. I'm going to go to Florida, or California. Florida. Let's do Florida. I'm going to go to Florida because I'm done here in Utah. Can I just get my $250,000 minus my deductible and move? The answer is yes, but you're entitled to move, but you still own that unit. And I don't know if you have a loan or not, the bank's going to still have an interest in it. And so you and your bank, either way, want to get that $250,000. And the insurance company will pay to replace what you've lost at that location, meaning in daybreak. So they're not going to say, oh yeah, we'll give you $250,000 minus your deductible so you can buy something else. The intent of the policy is to replace what you've lost at the location of the loss. And so in essence, what you would have to do is to rebuild or be part of rebuilding with your community and then sell your unit. Or potentially you could sell your unit sooner to some investor that wants to pick it up for probably a lot less money, knowing that they're going to get money back from the HOA. But you would in essence have to first sell your unit, then you could move. I've had people, mainly on the East Bench, high-rise condominiums, say, we're right dead smack with our brick concrete structure with a 2-story underground garage, which is kind of hard to insure, on the earthquake fault line, and we don't think if the fault starts to shear off, so Salt Lake's going to give us a permit to build it again. Yeah. What are we going to do then? I think statistically, here where we're at, you're not going to have to worry about that because of type of construction, the spread that we have, and just the ground, I don't think we'll have an issue rebuilding here in Daybreak. In Salt Lake, hypothetically, the policy actually is set up that it says if you can't rebuild what you've lost at that location, they will settle with you for some amount so you can rebuild somewhere else. That's a tricky one, but since this doesn't apply here, I'd rather not speculate on that one, because these are then a little different policies that you have to negotiate some different terms, and they're more money. But thank you for a great question.
Sorry, another question kind of related. So, in those cases, how much influence or say that your mortgage holder would have? You know, the building structure or whatever. You know.
For an earthquake loss?
Yes.
So that actually opens up the conversation about, you're welcome, what the association has to have as far as mandatory insurance or what's optional or voluntary insurance. And as you probably know, I'm going to go back here to my microphone so everybody can hear me okay. The mandatory insurance, the mortgage company actually will underwrite. That means they have an interest in that because they have a mandate to cover that. And so the mandatory insurance requirements are outlined by the Association Act in Utah, or Condo Act, and your governing documents that actually tie right nicely in it, require a special type policy with replacement cost insurance, but it does not address, the Association Act does not address earthquake and flood. Flood is addressed if you're in a flood zone, a federal flood zone, you have to have flood insurance. You're forced to have flood insurance. We're in an earthquake zone, but we're not talking about it. The lenders talk about it because Wells Fargo or some big national or international investors, they worry about losing their assets, because if the earthquake devastates your area, they face a huge financial loss. But it's not required in the law, and banks will just tolerate the fact that there's the risk of earthquake loss. So when it comes to underwriting a loan, mortgage, your lender will only look at what is mandatory, what is required. Stop me if I'm wrong here. The underwriter at the mortgage company does not underwrite on the earthquake insurance. When it comes to settlement of that, obviously you say, well, then why should I care about this? Why should the community care about this? Well, that's an individual or a homeowner as a whole association decision to say, where do I want to be next year if, hopefully it'll never happen, but if it were to happen, or we had a partial loss and we now have a $10 million assessment, where do we get the money? Where do we get the money? We can always get another loan, or do I want to have earthquake insurance? And so, the answer to your question is, the lenders don't really factor into that. I know it's burning underneath their fingernails. It's because of the cost. It's another elephant in the room that's just left there. So it's an individual mandate that you either have it or not. Now, Daybreak, being very advanced in the way they plan things, they look at things, the way things were built here, they've made it a practice in the governing documents that is part of the insurance that the earthquake and flood is included. And I can tell you for the last several years, it's been more of a trend where contracts or even investors and lenders want more and more earthquake security, because that's the one that could really wipe somebody out. So it actually has been more of a factor when we do some larger projects. The lenders or investors, especially if it's private money, they say, why should we give you a $30 million loan and you build right here in Salt Lake City, and who's going to give me the money back when we have an earthquake event? So they require earthquake insurance. Anybody have any other questions? Oh yeah.
So I just wanted to confirm, you were talking about getting an earthquake rider to your homeowner's insurance. So is it safe to assume that they can, if an earthquake came and you just have regular homeowner's insurance, they consider that like an act of God and they don't cover that? Is that what you're saying?
Yeah, I don't know, act of God is a tricky definition, it's typically not listed in most newer policies.
Okay.
But your personal homeowner's insurance policy, so your unit owner insurance, your HO6, or do you live in a single family dwelling? Single family, that's an HO3. That's an HO3 or 5. That's just when you go and order a sandwich, and then you have the menu with number 5, and then you know what to put in there. So your homeowner insurance policy, HO3 or HO5, standard does not come with earthquake. As a matter of fact, personally, when I buy mine, I can get my own individual insurance company, so like State Farm or Travelers or Nationwide or Avenue Acuity. Because we're in Utah and they know where we're at, they won't offer earthquake insurance or flood. And so what you would do as an individual homeowner, you would ask your agent to get you a quote for just earthquake alone. And then you'd go with the checklist and say, also my contents I need to insure, I need to have living expenses insured, and I want my home insured for $500,000 minus the deductible, and then you buy yourself an earthquake policy in a standalone market. When you compare that price versus what a community would pay and as a whole, you're going to be paying more. It's just a function of the market. So that's where communities that buy bulk have a huge advantage. When you buy bulk, you get a better price. Then you have other advantages living in a single family dwelling. Thank you for a great question. Well, we're an HOA, and we have a lot of boards asking us about that question, actually. So that would have been a chocolate if somebody would have asked me this question. It depends how deep the boards want to think about it, and I think you guys don't know how much infrastructure, maybe you do, you have in the ground or in bridges or in roads that really are not covered by a standard earthquake policy. And so it's an add-on and an additional cost. And so a lot of our smaller communities that we deal with, they forget about the infrastructures that could be a couple of millions of dollars. And here in your community is substantial that also if earthquake would hit, you're gonna have your home rebuilt, you're gonna have your community center rebuilt, you're gonna have your townhome rebuilt minus the deductible. But then there's another add-on that you would need to make sure that paved surfaces, walls, walkways, fences, foundation, pools, the bridges. We didn't list the bridges. There's not a lot of bridges in Utah. Tunnels if you have them here. Anyways, and then there was a definition of an occurrence. It's just how they look at what constitute one or multiple earthquakes. You would obviously want to have a longer occurrence time, 168 hours versus 72 hours, because what that means is then the next event after 72 hours would reset the clock and the deductible, and no, it's better to have a long occurrence. Most of them are 168, yeah, but that's one way, again, to lighten the load on premium, is to go with less room for that. Masonry veneer exclusion, that's if you have a single family dwelling or a lot of, mostly your community buildings are not pure brick buildings like mine is a real brick building from the 60s. A lot of these days it's masonry veneer. Most cheap insurance policies, they have, the biggest one is masonry veneer exclusion or veneer exclusion. And so you obviously would want to make sure that's included. Here it's not that big of an issue, but if you ever go somewhere else where your building is brick and you said we got a really cheap policy and it doesn't cover the veneer, then you're like, well, that's more than the 10% deductible. I think I talked about replacement, so do you think I should talk about anything else on that? Oh yeah, let's talk about price. Ronnie, how do we factor in pricing on earthquake insurance here in Utah? Different places factor a little bit differently, but in Utah, construction type is a big factor. Like I mentioned earlier, prior to 1950, construction standards on a lot of structures were in such a way that even if you had a high-rise building, that thing will buckle and not bend, and it'll just collapse. And those buildings are very difficult to insure or extremely expensive. Anything after 2005, 2006 has been built to a much newer standard, and newer structures that we have in general here are wood frame, bolted foundation. They tend to do really well in an earthquake scenario. And I think now that we know that liquefaction is not a factor, and yes, we have the fault line, but you're in the solid or more solid zone, I think personally would say this is a better area. It was going to fare better your community than others. Primarily, the code in a lot of areas is addressing not the survivability of the structure, but your ability to get out of the building alive. When you go downtown Salt Lake City and you look at the new police headquarters and the main building that was built, that building, I don't know if you've noticed that how they built and how much money they went in there, that thing is going to stand and supposed to withstand the earthquake so that the authorities can use that as a home base and deal with an earthquake or catastrophic event. So that building is actually built so it'll stand and is going to be functional. Most building codes, even now today, is for your structure. It's not going to collapse and kill you. It's great. And you can get out. I can talk about this because my building was built in 1968, so we have some shortcomings that would cost a lot of money to fix it. Occupancy, that means, where do we live and who lives in it? It's a garage, or is it individuals living there, residences or more. Earthquake protection, again, that comes into play with construction type, but you can retrofit a building. They do it a lot in California, here in Utah. It depends. The high rises, yes. Individual structures, not so much. The exposure environment, like where we're located at, the soil type, the different soil types, landslide could be a factor where if you're on the hillside and you trigger a landslide because of the earthquake, so it could be fine on your structure, but then the landslide could wipe you out, so that's an issue. Liquefaction, we talked about that. Distance to the fault comes into play, and then honestly, earthquake insurance is a commodity pricing because, like I mentioned earlier, it's not mandated by the lenders. It's not really a code requirement. It's an individual factor. Depending on the market condition, that's how pricing happens. And we've seen a spike in premiums over the last 2-3 years. And you said, why us? We just had the little incident with the elephant in the room here. 500 years, we haven't really had much. Unfortunately, though, and the other slide that I included there, I just pulled something off the state of Utah earthquake activity from April 1st to June 1st. It's a separate little line item. And all the red dots are events that they registered in Utah. This is not the fearmonger. This is just kind of explaining why the cost is high or somewhat, costly for earthquake insurance. Because since in the first quarter, since April to June, they registered 460 earthquakes within the state of Utah, what constitutes some sort of earth movement. And the insurance industry, they don't just focus on Utah, whether we like it or not, we're a small market for them. They like Utah insurance companies because of it's a business-friendly environment. We don't have a lot of the wind and hail issues. We have a good legal climate, and a lot of things are fairly new. So it's a favorable place for insurance companies to want to do business, which has been driving our pricing down. Because like I mentioned, in Colorado, 3 times more, 4 times more, never mind New York or the West Coast. So they want to spread their risk and do business in Utah and or other states and countries around the world. But we've seen a lot of catastrophic events that have hit the wallets of big insurance companies. And the way insurance works in Utah, but other states as well. Let's say you're with State Farm or with Travelers. Travelers puts forth a policy, or Lloyd's of London. They typically will have reinsurance in the back for a certain amount of money that's over what they were willing to pay. And that threshold is usually rather low. It's $1 million to $2 million. So if an insurance company pays out $20 million, it may not come from Travelers. Maybe the first $2 million come from Travelers, and then the rest comes from reinsurance companies. And there's only about a handful, maybe a dozen or so major international reinsurance companies. And they also tie a little bit with Lloyd's of London. And every time you hear, watch the news, and I try not to get hung up again on all these catastrophic events. For the one thing though, is anytime there's an event in Japan or China, there's a good chance that the same insurance company that's backing your Travelers or your Allstate has also backed up the Chinese insurance company or the Japanese company or the European company, because again, there's only a handful or so of big international reinsurance companies, and it's hitting their wallets, and it's been not profitable. You don't go to work and not make money, and business doesn't do business and not make money. And for a long period of time, for the last 3 to 4 years, losses have exceeded what they had allocated in premiums. And so we've seen an increase, a steady increase in rate. And here in Utah, we had this unfortunate event with last year's event and overall price increases with catastrophic insurance. And so we're seeing a spike in earthquake insurance rates. We're not going to be like Denver or Colorado or the Midwest, because every time they have a wind event, that's just more fuel off on their pricing. We typically have been exempt from that, but earthquake pricing has seen an increase, and so have some property rates. Construction, I think that's fine. We don't need to do that because we're almost at the end here. No, we can skip that. Oh yeah, Lisa, just go back on this. This is a good picture of what I say is not a great. So if you're looking at another place to buy sometime in the future, if your place looks like this and you're in an earthquake zone, that's not what you would want to move into. Or this one. Luckily, again, you don't have that issue. These are some of our Salt Lake high-rise buildings, structures. It's best to have your garage detached or attached to the building is not bad. These can be really problematic, especially the ones from the 60s or so. They're just going to fare a lot worse. Yeah, pricing is increasing, and how can you fight pricing is to go with a higher deductible and or sublimits. What a sublimit means is your community is $20 million, and you're going to say statistically where we're located at, we don't think there's going to be a full catastrophic loss. Chances are it's going to be just a partial loss, so we just buy $10 million worth of earthquake insurance because we got sticker shock on our insurance pricing, and we just get a lower limit. Typically, those sublimits don't really save half the price on the premium because statistically, your first 50% or so is more likely to go out than the second half. And so by cutting your insurance in half as far as the limits does not translate into half the premium. We talked about that, loss of use.
That's it?
Yep, that's it.
That's it.
Oh, questions? Okay.
You don't have to give me can't
Our
really do
setup,
it.
so we have the garage underneath, and they didn't ask us anything on our insurance about that, so should we include our insurance on the garage?
It's very typically, the underwriters know construction type in Utah, and rating as such.
So that'll include the house and the condo and the garage.
Do you live in a condo or a
I
townhome?
live in the big one with the 13 units.
Yeah.
Yeah.
All
Yeah,
of
we,
them.
that's all factored in.
Yeah,
Yeah, that's a,
and they're all built with the garages underneath.
yeah. So you're good on that one.
Oh, goody.
I had a question going back here at the beginning, but I didn't know whether we were supposed to interrupt you or ask questions. On the, it was called subsidence. What is that?
I don't like this word, but it's a good one.
I'm sorry, I didn't.
No,
I've never heard
you
that
don't
word
have,
before.
yeah, and if you never had to deal with it, you're really lucky. Subsidence is basically if the dirt that your home is built on starts to settle or sink, and in St. George actually expands, and so that both is considered subsidence, and both can be really bad for your home. And what causes subsidence? Usually it's a man-made issue. When they build on any piece of land in Utah, they're supposed to do a geotechnical report, and a geotech will say this ground is very unstable, and so if you put the footing and foundation on there and build a home, it'll just start to tilt, or things will start to settle. That is subsidence. It's something that can be avoided today with building standards. They say, well, what about my building from 1950? Good news, or mine from the 60s. All the good and bad things already happened. So subsidence is only to new construction in that definition that I'm going to. So you have a subsidence risk in Utah on new construction because of faulty or defective construction zoning or planning. That is not earthquake, and that's why I don't like to talk about subsidence, because it's very devastating on the homeowner, because you end up with a home that you paid good money for it, and it's starting to sink. You can't close your doors anymore, your closets don't close anymore, you have cracks in the walls, your foundation starts to crack, and the fix is somewhere between $20,000 if you're lucky to $75,000, where they put in helical piers in the ground if they can to find solid bedrock, pump your building back up, and then rebuild the foundation. And that's how you avoid subsidence. In St. George, because we're a good state, we have different kinds of problems. In St. George, it's a desert, dry climate, and there's layers in the ground that they call expansive soil. It's so dry, it's like a sponge that has been dried, and if you don't touch it and you don't water it, it'll just be like there forever, because it's been there like forever. In St. George, with the new developments and everything else, they try to over-excavate down a certain level, so when you build a community on there and have green grass, and you have homeowners watering 3-4 times a day, because they like green grass in the desert, the water goes down 12 to 16 feet and hits that expansive soil. You start now creating that sponge effect, and so that is subsidence. Well, it's called expansive soil, but it's never defined. But when you look at subsidence, or the definition of your homeowner's policy, they do not cover subsidence. It's a big no-no. Now, you don't really have to worry about this here, individual homeowners, but you have recourse with your builders. There's a 6-year applied warranty for habitability. So if you have a single family dwelling, subsidence, in my opinion, and you ask attorneys, it would trigger a habitability item, meaning you can't live there anymore. So regardless of what the builder warranty says, there's a state court case that says subsidence, well, not the subsidence in general, but that would constitute as a habitability item, and so you have recourse against the builder. And so then, like, what about after 6 years? Well, unless you're in St. George and you have that expansive soil where it's always there, the dirt typically settles within the first year to 2 years, and after that, it's not going to settle anymore. So I wouldn't worry about too much on subsidence. Earthquake can trigger some subsidence, and so if the earthquake triggers subsidence, then that would be covered. But not subsidence just because it's a man-made factor.
So if it's like here, does that have anything to do with the water, the soil, or is that the liquefaction of the sand, or what?
Well, you deserve another chocolate.
That's right, you keep your chocolate.
There's two items to address. You can have groundwater in the ground, and I don't know if you've been one of those homeowners or anybody remembers that when this was first built, this community, there's a river going through this community, underground river. I don't know where it's at. I saw it on a map. There's a river. And builders started building on top of the river, but it's in the ground, it's gone. But water would run off from Ochre Mountains, and instead of above the ground, it really runs underground. And that's a flood. It's a 4-letter word. And even though we weren't in a flood zone, it still flooded the buildings because they thought with the geotechs and the engineers that, oh no, I think we can build here. And some homes actually will have no basement and the reason is because you have some underground water. We have in Utah some areas where usually the water table is fairly deep, like 6 to 12 feet down. But you have some areas in the country where you start digging a hole and you got water coming up. Usually Florida, that's not the case. And so you could have that issue as a homeowner, where you could have water coming into a building because of a flood, above water, or below water. Liquefaction is basically, we have a town called Sandy. The whole mountain over there is built on sand, even though that's more on granite. You saw on the map. The sand itself wasn't the problem. The problem is closer by the Great Salt Lake and where the Jordan River is, where that's more of a sandy, moist ground. And liquefaction with earthquake has a devastating or more devastating effect because that creates a ripple effect. So it's like if you have sandy ground that's saturated with water, it tends to be more prone to seismic activity actually causing damage to you versus solid ground or granite, a lot of places. Does that answer your question? That was a little complicated answer.
Do you want to hit really quick on earthquake loss assessment? It's the one thing we didn't talk about when we talked about unit owner insurance.
Sure.
Okay.
Do you want me to talk about the coverage or?
Just why it's important and what is different from coverage A to loss assessment.
Okay. I'm trying to keep this nice and sweet. So when your HO6 policy, right? Thank you. When you buy your HO6 policy, and that'll just be some preaching here on what individual homeowners, you don't need to listen about that, but if you ever are in a town-owned community, and when you read the checklist, I'm sure the community manager sends it out, but we created, Missy and I and our team create a checklist. And as a unit owner living in a townhome, one of the items that you want to make sure is get coverage A for your deductible, which is part of the structure, and loss assessment. And you want to get both to the same amount of what your deductible is.
You want loss assessment for
and
as much as you can.
And if you have earthquake insurance and you want to protect yourself from a deductible assessment coming from your homeowners association that is now gets an $18 million check but still needs to collect $25,000 from all of you so we can rebuild, you also want to make sure you have what is called earthquake assessment. And so you want to get that assessment, loss assessment, if you're worried about earthquake, as high as you can get it. each individual insurance company is a little differently, but that's a good one to take with you, earthquake loss assessment. That's it.
One more. Does the HOA cover if, like, living expenses, the HOA part of the insurance, or would you have to actually get extra insurance with the rider?
So if you had a fire in your kitchen
Yeah, well, earthquake.
or earthquake, the answer is no. You would have to. That's on your personal insurance. You don't have to have HO6 insurance. It's not required. It's implied in the law, so you could still face the deductible, or they can assess you. But that's oftentimes the first thing we get when people don't have insurance. I got to be in the hotel for 2 weeks. Who's going to pay for the hotel and the storage unit and my damaged furniture? That's on you, because that's your unit. You are a homeowner or a unit owner, not a renter. So it's important that you get HO6 insurance, and they're very inexpensive. I almost said when I said cheap. Yeah, $150 a year. So. Okay. Anybody else? No other questions?
What is the difference between a riser and a whole earthquake insurance?
So I'll give you an example. You could like some insurance underwriters, especially the unit owners insurance companies, well, just because it's such a small risk for them, they only face $25,000 or maybe $100,000. They'll throw it on there as a rider. So usually they would say, never in a million years will you offer earthquake insurance, but because it's a small package like your unit owner policy, you can get them to give you an earthquake rider. Typically, as an individual homeowner, ask them to give you an earthquake rider. Not so much, it depends on the insurance company and what their appetite is. They won't give you a rider for earthquake insurance. You go and buy your own individual policy as a separate standalone item.
You talked a lot about national occurrences and other places. Can you recap what do we really need to have here?
As far as insurance?
Yes,
Do you live in a townhome,
I
or
live in a town.
where do you live?
I live in 4881.
What's the community called?
It's called Garden Park.
Oh, Garden Park. So we have a checklist. I like checklists, and I don't always like to read a lot of stuff if it doesn't interest me. So insurance
You have
happens
it
to
with you?
interest me. I don't have, because we have to have 1,000 notices. But if you give me your email address, I'll email you the checklist. It goes out to all your managers once a year, and I'm sure they post it as well.
My insurance couldn't find it.
What
on
you look?
the online site.
Oh, okay.
It's on
Yeah,
the
it's
website.
It's on Lift Avery's website.
I'll be happy
You
to
give me your email address, and I'll send it to you. So we'll do that, and there's a checklist, and then it just gives you a list of items. Because I'm out of time, but if you give me your email address, and I'll send you a checklist. You're welcome.
Can I write mine on there too?
Absolutely. And you're Garden Park too, right?
Yeah.
Yeah. Old Garden Park. So I'll just have her put it here. Okay. Thank you.
Thank you.
everyone.